18 months. That's the estimated window that several major institutional research reports suggest remains before current dollar dynamics shift fundamentally. Not decades, not someday. A specific, measurable time frame that the world's largest asset managers are actively positioning around. And if you think institutional positioning timelines don't affect you personally, I need you to pay close attention to what the money is actually doing. Because while financial media debates whether the dollar will remain dominant, the institutions that manage trillions aren't debating. They're moving, quietly, systematically, with urgency that contradicts their calm public statements. The dollar window, the period when dollar-denominated assets can be exchanged for real assets at current valuations, appears to be narrowing, and the smart money isn't waiting to find out if the window closes completely. While you were reading headlines about dollar strength and American economic resilience, the institutions managing the world's largest pools of capital were executing a different strategy entirely. BlackRock, Vanguard, State Street, Bridgewater, the sovereign wealth funds of Norway, Singapore, Saudi Arabia, and China. According to publicly filed portfolio disclosures and regulatory reports, these institutions have been systematically adjusting allocations in ways that suggest preparation for dollar regime change. Not abandoning dollars, not panicking. Systematically reducing concentrated dollar exposure while increasing positions in assets that historically perform when reserve currencies weaken. The moves are visible in their quarterly filings. The pattern is consistent across institutions. The timeline appears compressed compared to previous adjustment cycles. They're not announcing what they're doing. They're not explaining why, but the filings tell a story. And the story suggests the smart money sees something approaching that most retail investors haven't considered. Now, let me be precise about sources before we continue. I'm drawing from SEC 13F filings, which reveal institutional equity holdings, from sovereign wealth fund annual reports, from Federal Reserve flow of funds data, from IMF reserve currency composition statistics, from central bank gold purchase records compiled by the World Gold Council. These are official sources, regulatory filings, publicly available data. I'm not claiming to know exactly what institutions are thinking. I'm presenting documented portfolio changes, historical patterns of similar positioning, and what such changes have historically preceded. The data is public, the pattern is historical, the implications are worth understanding. By the end of this video, you'll understand exactly what major institutions are doing with their dollar exposure, why they appear to be acting with unusual urgency, and what historical precedent tells us about windows of opportunity during monetary transitions. Because here's what most people don't realize. There have been windows before. Periods when those who recognized monetary transition early could reposition advantageously. Periods that closed, sometimes suddenly, leaving those who waited with dramatically fewer options. There's a documented pattern here. A pattern where smart money moves 18 to 36 months before conditions force everyone else to move. Where early positioning captures opportunity, while late positioning captures whatever remains. Same sequence across transitions. Same institutional behavior, same window dynamics. The only question is whether you understand what the current positioning signals while options remain available, or whether you'll recognize it only after the window has narrowed significantly. Stay with me. The next 15 minutes will reveal what the largest pools of capital are actually doing right now. To understand what smart money positioning actually reveals, you need to understand how institutional capital moves during monetary transitions. Not the simplified version, the actual mechanics that repeat across history. Every major currency transition has featured a predictable window pattern. A period when those with information and resources could reposition before conditions changed. This isn't theory. This is documented financial history. Phase 1, early recognition window. Sophisticated institutions, those with the best research, the deepest data access, the longest time horizons, begin adjusting positions. The adjustments are small relative to total portfolios. They don't move markets. They don't generate headlines. This window typically requires 24 to 36 months. During this time, the incumbent currency remains strong. Official narratives emphasize stability. Most observers see no reason for concern. Phase 2, accelerated positioning window. More institutions recognize what early movers saw. Positioning accelerates. The changes become visible in aggregate data, but are still dismissed as routine rebalancing. Premiums for alternative assets begin rising. This window typically lasts 12 to 18 months. The incumbent currency may still appear strong, but stress indicators emerge for those watching closely. Phase 3, narrowing window. Institutional positioning becomes crowded. The best opportunities have been captured by early movers. Alternative assets become expensive. The costs of repositioning rise significantly. This window lasts 6 to 12 months. Those who move during this phase still benefit, but capture less advantage than early movers. Phase 4, closed window. The transition becomes obvious to everyone. The incumbent currency adjusts. Those still holding concentrated positions experience the full impact. Repositioning at this point means exchanging depreciated currency for appreciated alternatives at unfavorable rates. The window is closed. The opportunity to position advantageously has passed. Now let me prove this pattern is real. 3 examples. 3 currency transitions. Same window dynamics in each case. 1967 to 1971. The dollar-gold window. This example matters because it demonstrates exactly how a window works, who moved early, and what happened to those who waited. By 1967, sophisticated observers recognized that America had printed more dollars than its gold reserves could support. The Bretton Woods system, which promised $35 per ounce convertibility, was under strain. Early movers, primarily European central banks led by France, began converting dollar reserves to gold. They recognized the window while it remained open. Phase 1, early recognition. The smart money moved first. Between 1967 and 1969, gold conversion requests accelerated. More institutions recognized the opportunity. The window remained open, but available gold diminished with each conversion. Phase 2, accelerated positioning. The window narrowed as more participants entered. By early 1971, the rush became urgent. Those who hadn't converted watched American gold reserves plummet. The Nixon administration faced imminent reserve exhaustion. Phase 3, the window narrowing rapidly. August 15, 1971. Nixon closed the gold window. Convertibility ended. The dollar devalued. Those still holding unconverted dollars saw purchasing power decline dramatically over the following years. Phase 4. Window closed. Opportunity passed. Gold rose from $35 to over $800 by 1980. A 2,200% increase. Those who converted early captured most of that gain. Those who waited until the window closed watched their dollar purchasing power erode. The pattern was clear. Early recognition, accelerated positioning, narrowing opportunity, closed window. Those who understood the window moved while options existed. Those who trusted official assurances discovered the window had closed. 1997 to 1998, the Asian currency window. This example matters because it shows how quickly windows can close when confidence breaks, and what happens to those caught concentrated in weakening currencies. By early 1997, sophisticated analysts recognized stress building in Asian currency systems. Thailand, Indonesia, South Korea, and others had accumulated dollar-denominated debts while maintaining currency pegs that were becoming unsustainable. The smart money, primarily hedge funds and international banks, began reducing exposure. They moved into dollars and out of Asian currencies before the crisis became obvious. Phase 1, early recognition by sophisticated capital. Through mid-1997, more institutions noticed. Capital outflows from Asian markets accelerated. The window for exiting Asian currency exposure narrowed as selling pressure built. Phase 2, accelerated positioning created market stress, July 1997. Thailand's peg broke. The window slammed partially closed. Thai baht holders saw immediate 20% plus losses, but other Asian currencies still held their pegs. A narrower window remained. Phase 3, the window narrowing country by country. Within months, Indonesia, South Korea, and others experienced currency collapses. The window that had been open for early movers closed completely. Those still holding concentrated Asian currency exposure faced losses exceeding 50 or 80%. Phase 4, window closed across the region. The timeline from early recognition to complete window closure, approximately 18 months. Those who recognized the window enacted early preserved capital or even profited from the transition. Those who waited for confirmation, for certainty, discovered that certainty arrived only after the window had closed. 2006 to 2008, the credit window. This example matters because it's recent, well documented, and shows how institutional positioning preceded the 2008 crisis by years. By 2006, a handful of sophisticated investors recognized that the U.S. housing market and associated credit instruments were unsustainable. The data was visible to anyone examining subprime default rates, credit standards, and leverage ratios. The smart money began positioning. Michael Burry, Steve Eisman, John Paulson, and others bought protection against mortgage-backed securities. They recognized the window while housing prices still rose. Phase 1, early recognition by contrarian analysts. Throughout 2007, more institutions noticed. The subprime market showed visible cracks. Hedge funds and sophisticated investors accelerated protective positioning. But housing prices remained elevated. Official narratives emphasized containment. Phase 2, accelerated positioning while the window remained open. Early 2008. Bear stearns collapsed. The window narrowed dramatically. Credit protection became expensive. The opportunity to position advantageously was closing rapidly. Phase 3, window narrowing, as crisis emerged. September 2008. Lehman Brothers failed. The window slammed closed. Those still holding concentrated exposure to mortgage-related assets faced catastrophic losses. Phase 4. Window closed. The investors who recognized the window in 2006 and positioned through 2007 made billions. Those who waited for certainty, who trusted official assurances of containment, faced the full impact of the crisis. The window was open for approximately 24 months before closing rapidly. 3 examples. 3 different assets. Same window dynamics, same pattern of early recognition, accelerated positioning, narrowing opportunity, and closed window. Now let me show you what the smart money is doing right now, and why the positioning suggests they believe a dollar window may be narrowing. The institutional equity shift. According to 13F filings analyzed by financial research firms, major institutions have been increasing international equity allocations relative to U.S. equity allocations over recent quarters. This doesn't mean selling all U.S. stocks. It means relative positioning. When institutions that have been overweight U.S. equities for years begin shifting toward international diversification, the change in direction matters. The magnitude varies by institution, but the direction is consistent across multiple major asset managers. The sovereign wealth fund pattern. Sovereign wealth funds from China, Singapore, Norway, and the Gulf states have disclosed increased allocations to non-dollar assets over recent years. Real estate in Europe and Asia, infrastructure projects outside dollar jurisdictions, private equity in emerging markets, gold and commodity exposure. These are long-term investors with access to the best global research. Their positioning reflects multi-decade thinking about where value will accumulate. The central bank gold accumulation. We've covered this in previous videos, but it bears repeating in this context. Central banks collectively have been buying gold at the fastest pace in decades, according to World Gold Council data. China, Russia, India, Turkey, Poland, Singapore, and numerous other nations have been adding to reserves. Central banks hold reserves to protect against currency instability. When central banks collectively buy gold while reducing dollar reserve allocations, they're expressing a view about future currency dynamics. The buying isn't secret, it's documented in official reports. The implication is that central banks, the institutions that create and manage currencies, are diversifying away from concentrated dollar positions. The corporate treasury shift. Major multinational corporations have been adjusting treasury management practices. More hedging of dollar exposure, more holding of cash in multiple currencies, more diversification of banking relationships across jurisdictions. These changes don't make headlines. They appear in footnotes of annual reports, in treasury management conference discussions, in banking relationship data. Corporations that earn revenue globally are preparing for scenarios where dollar strength cannot be assumed. The timeline indicators. Several factors suggest smart money believes the window may be narrowing. The pace of central bank gold buying has accelerated, not stabilized. BRICS nations are actively building alternative payment infrastructure. De-dollarization discussions have moved from academic to operational. U.S. fiscal trajectory shows no sign of improvement. Debt continues growing faster than economy. The Federal Reserve faces impossible trade-offs between inflation control and debt service costs. None of these factors prove imminent crisis. All of them suggest conditions that could accelerate monetary transition. If historical patterns hold, and they've held for centuries, windows narrow before transitions become obvious. Smart money moves during phases 1 and 2. The general public discovers the transition during phase 4 after the window is closed. Current institutional positioning suggests we may be transitioning from phase 1 to phase 2. Now I know what some of you are thinking. Let me address the counter-arguments directly. But the dollar is still the world's reserve currency. It's still dominant. True. Approximately 59% of global reserves remain in dollars, according to IMF data. That's dominant, but consider the trajectory. In 2000, dollar share was over 70%. The trend has been persistent decline for 2 decades. Reserve currency transitions don't happen overnight. They happen gradually, then suddenly. The window exists during the gradual phase. It closes during the sudden phase. But there's no alternative to the dollar. What would replace it? The assumption that one currency must replace another may be outdated. The future may feature a multi-currency system. Dollar, euro, yuan, and perhaps gold or other assets sharing reserve functions. No single replacement, but reduced dollar dominance. In such a scenario, assets diversified across multiple currencies, and real assets would outperform those concentrated in dollars. But smart money has been wrong before. They're not always right. Absolutely true. Institutional positioning isn't a guarantee of outcomes, but consider the asymmetry. If institutions are wrong and dollar dominance continues unchanged, diversified positions slightly underperform concentrated dollar positions. Modest opportunity cost. If institutions are right and the dollar weakens significantly, concentrated dollar positions suffer substantially. Major capital impairment. The asymmetry of outcomes may explain why institutions are positioning conservatively even without certainty about timing. But I can always reposition later when the trend becomes clear. This is the Phase 4 mindset. Waiting for clarity means waiting for the window to close. By the time trends are clear, the best opportunities have been captured. Repositioning during Phase 4 means exchanging depreciated assets for appreciated assets at unfavorable rates. The window exists precisely because the future is uncertain. Certainty arrives only after the window closes. So what does this mean for you? Practically, specifically. Right now, I'm not a financial advisor. I can't tell you what to do with your money. But I can share what the institutional positioning suggests and what historically informed observers consider during window periods. First, recognize where you likely stand. Most individual investors are heavily concentrated in dollar-denominated assets, U.S. stocks, U.S. bonds, U.S. real estate, dollar savings accounts. If you're typical, your portfolio is far more dollar-concentrated than the institutions that manage trillions. That gap might be intentional and appropriate for your situation, or it might reflect default positioning you haven't critically examined. Second, understand what diversification means in this context. Diversification isn't owning different U.S. stocks. That's concentration disguised as diversification. True currency diversification means exposure to non-dollar assets, international equities and local currencies, commodities, precious metals, real estate in non-dollar jurisdictions, foreign currency positions. You don't need to eliminate dollar exposure. You might consider whether concentration at current levels matches your view of future currency dynamics. Third, consider the window timeline. If historical patterns hold, windows typically last 18 to 36 months during Phase 1 and 2 combined. Exact timing is impossible to predict. But the institutions that moved early in previous transitions captured the most advantage. Those who waited until Phase 3 captured less. Those who waited until Phase 4 captured nothing or faced losses. The window may be earlier or later than anyone predicts, but waiting for certainty historically means waiting too long. Fourth, evaluate asymmetry in your positioning. If dollar dominance continues indefinitely, what's your downside from modest diversification? Probably some opportunity cost. Modest. If dollar dominance weakens significantly, what's your downside from concentrated dollar exposure? Potentially substantial capital impairment. Understanding this asymmetry doesn't tell you what to do, but it should inform how you think about positioning. Fifth, watch what institutions do, not what they say. Public statements from major institutions emphasize confidence. Quarterly filings reveal positioning. The gap between statements and actions is informative. Track 13 F filings. Track central bank reserve disclosures. Track sovereign wealth fund annual reports. The data reveals actual behavior. Drop a comment below. Tell me how you're thinking about dollar exposure, whether you're seeing the same institutional patterns. What questions remain unanswered? I read every comment. This channel grows through engaged discussion with people who recognize that the most important investment insights often come from watching what large institutions actually do rather than what headlines say. Here's what I want you to remember. Windows don't announce when they're closing. They narrow gradually, then close suddenly. Those who moved during the open window benefit. Those who waited for certainty face the closed window. The smart money is moving. The positioning is documented in public filings. The direction is consistent across institutions. The timeline appears compressed. Maybe the window stays open longer than anyone expects. Maybe dollar dominance continues for decades. Or maybe the institutions managing trillions of dollars, with access to the best research and the longest time horizons, are seeing something that individual investors haven't fully considered. The filings are public. The pattern is historical. The positioning is documented. You don't have to make the same moves institutions are making, but you should at least understand what they're doing and why their behavior might differ from their public statements. The window doesn't care if you believe it's closing. It doesn't wait for your decision. It just narrows, like it always has, until one day it's not open anymore. Thanks for watching The Silent Economy. And remember, the people who benefit from monetary transitions aren't always the ones with the most capital. They're the ones who recognize the window while it remained open. The data is public. The pattern is historical. The choice to act is yours.